We have a very special guest with us today, Manpreet Gill, CIO of Africa, Middle East and Europe at Standard Chartered, with us in the studios. Manpreet, thanks so much for joining in. And we love reading your note, by the way, and would love to talk about that in detail. But can I start off with a bit of a micro? Since we just spoke about Anthem Bio, it's about to listing it as well. And India is seeing this flurry of paper coming, both primary and secondaries per se, or FPOs happening, and even stake sales happening. What have you made of the kind of supply in the Indian markets and new listings like Anthem, for example?
So I think the supply, if you take a sort of top-down macro view, that's a really positive sign in terms of confidence and maturity in a market, right? And I think it's interesting to look at IPO market rankings around the world. Indian markets are now up there amongst sort of the top-ranked markets. And while we can debate performance of total returns in the last sort of couple of quarters, at the end of the day, the fact that more companies are finding confidence they're able to raise capital, that attractiveness from an IPO perspective, the fact that investor flows are also forthcoming, to me, that's a positive sign in terms of market depth, looking out over the longer run, which is the time horizon we focus on. And that's why we still think that, it's a market that we're fairly optimistic on, despite some of the challenges of the last couple of quarters.
Is there a concern that there would be a lot of subpar paper also, which makes it with this flood? It's becoming more and more difficult for people to sift through, isn't it?
Well, I guess that's always going to be a challenge with a large amount of listings, right? Yeah. The research around trying to separate, what is likely well-performing versus what is not, that's always a challenge. But I think that the big macro takeaway is when you look at, IPO volumes, as a macro indicator for most markets, that's been quite a positive. When you look at, Hong Kong, for example, is another market which has sort of had a strong IPO pipeline. That tends to be one more indicator of positive returns over the following 6 to 12 months.
Manpreet, let's get to the bigger picture. And I want to start with the last few months have been a roller coaster, to say the least, in terms of the world trying to understand what the new US president is going to do and what that trade deals, the back and forth actually mean. Do you think that the broad narrative now is it's not going to be as bad as we thought? And do you think that's the wrong way to look at it?
Well, I think we should be prepared for surprises. Early April clearly was a surprise to a market that still expected some form of tariffs. But I think the lesson is more to find ways to live with the volatility, because the other lesson from Q2 is that equity markets have done extremely well over the quarter. With the benefit of hindsight, the best thing would have been to either stay invested and do nothing or buy into that pullback. But having said that, looking forward, look, while a lot of the growth and earnings side still points to a lot of optimism, we're prepared for a little bit of volatility, which we think is reasonable after just the magnitude of gains we've got so far. But the risk we're keeping an eye on is inflation, because if something were to go wrong on the tariff side, where we'd see it from a market perspective is in inflation numbers. First in the US, but I think that's really where any risk would come through. We're not worried about it in our base case, but that's the one down risk we're keeping an eye on.
I just wonder, how concerned are you about the possibility that Powell goes? I know we look at it more as a political move one way or the other, but if he goes, and this whole question of then what happens with interest rates and the credibility of the Federal Reserve, do you think that that's one big iceberg that we've just seen the tip off so far?
So I agree. It's something we need to keep a close watch on. I think we need to balance it with the fact that Trump, even in his first 6 months, has a track record of saying a lot of things, then pulling them back, and we've seen the same thing with the central bank. Look, Powell's term completes his term next year as it is, so naturally there will be a focus on who the next governor and what their policy is likely to be, and what they do once they actually come into office versus what they say before. So I agree with you, it's something we need to keep a watch on. But I think equally we shouldn't take our eye off the ball in terms of what the growth and inflation data is telling us, because inflation is a risk, a concern. The Fed has told us that. But equally, there's a job market that's perhaps slightly on the softer side as well, which in our view, that will be enough to trigger, start of more rate cuts, even in Powell's base case later this year. But you're right, I think that's still one thing we'd keep a watch on.
When clients talk to you or you talk to your clients and etc., I mean, India's always been expensive, so that's not a surprise. But we're just talking about this morning as well, Manpreet, with what's happening. Japan, a regime change, South Korea, regime change, Germany, regime change, UK, perennial regime change. India's political stability, growth northwards of 6%, very likely to go to 7% this year. Stable finances, stable current account deficits, everything. Will foreigners invest for all of these positives, or will they say, no, valuations are expensive, as they always have been?
So to be honest, I'd worry less about that headline valuation number.
Okay.
It's when you worry, yes, it's one of those things you want to keep a watch on, but it's equally natural for valuations to be on the higher side when a market is doing well. And we made the point many times before that, including everything you've said, we agree with you, but also in a return on equity perspective, that justifies valuations where they are. I think the real headwind to foreign investor flows has been the fact that flows to emerging markets have been under pressure in a world where the dollar was strong. That's the world we've been in since 2022. And actually, that's the world we think we're slowly moving out of. So I think what we'd watch more closely is the fact if we start to get a generally weak dollar, which we think we're starting to see the first signs of, that will really unlock a lot of capital flows into India and into maybe Asia as a broader level, because that's in fact one of the best indicators of foreign investor flows.
Interesting. Okay. So, Manpreet, when you kind of, you may not get into the minutiae per se at the level at which you are looking at EMs in general, but when you look at India, therefore, and I take it that you are looking at India constructively, what stands out? I mean, is it the consumer-focused themes which stand out, or will you still bank on capex, even though private capex has been elusive thus far?
So I'd really argue it's a combination of both. I think the consumer spending story clearly jumps out as one of the primary ones. And that's not just from a historical track record perspective, but I think a lot of the recent policy stimulus has tried to push in that direction. Whether you look at the fiscal stimulus much earlier in the year on the budget, or now the fact that we got RBI rate cuts that were more than what the market expected. So I think that'll still be one theme. And I think that really helps consumer, it helps the headline sort of earnings growth story and improves the outlook forward looking. But I think there's still a lot of, individual stories as well. So financials is a sector we particularly like, and I think that's an example where consumer story plays into some degree through improved credit quality, but I think that's more linked to broader macro growth, an easier way to buy into that story, at least from an equity market perspective. So I think it's that combination that really looks interesting. There is always going to be the relative challenge for international investors, right? So the positive India story versus what I call the extreme cyclicality of North Asian equity markets on the way up. So that relative story is always going to be a challenge. But for us, that's why what we've done is moved an overweight to Asia ex-Japan first, which includes India, before we get to that regional debate.
Yeah, but even in that ex-Japan, which includes India, what is the weightage that India actually has?
So we use benchmark weights, market benchmark weights, of which India is still now becoming an increasingly large share, right? So I think that's a positive sign. The debate and the challenge for many Asia ex-Japan investors is going to be, okay, in a bull market, when equities are doing well, Asia is doing well, North Asian equities, your China, but also your Korea, tend to outperform in relative terms.
Yeah.
So in terms of percentage of shares, you might see a little bit more going that way. We sort of shifted our relative weights in that direction as well. But usually, as long as you get a rise in flows to EM, to Asia ex-Japan, Indian markets tend to benefit quite a bit from that, regardless of, the regional debate tends to be an ongoing one, which investors look at month to month anyway.
Yeah, no, so from the Indian perspective, I think some may argue that the dependence on foreign flows has come down, robust, domestic flows coming in. But having said that, the India story, though theoretically seems to tick all the boxes, around the edges there seems to be a hesitancy in what's happening. Do you think that's derived from earnings? And early days to ask for your take on earnings, but some of the big ones are already out.
So earnings, I think it's, what's important here is the starting point. I think looking backwards, what explains some of the tepid returns is the fact there's a readjustment to what was tepid earnings growth. The thing with markets is it's more about, beating expectations. And I think we're coming off much more subdued expectations. So I would not expect a return to the heady days of 20% plus returns on markets. We know on average those are well above average and not something we should expect to persist. But I think as long as we get a return to earnings growth that reflects the stability and strength of economic growth, we think that'll be enough for equities to outperform bonds and cash, which is really the main point we're driving.
Very interesting. Okay. The last 3 years, because of revenge spending or what have you, on the consumption side, Manpreet, the upper end of the K curve really hit it out of the park. Do you believe that will continue? So things like hotels, things like the consumer tech firms, etc., maybe even investing firms, because a lot of saved money is going into the capital markets. Do all of these continue to remain favored themes to your mind?
So yes, to the extent that they feed into the consumer discretionary story that we discussed earlier. So I think that's where maybe a sector strategy could be one way to explain it, saying, yes, we'd still rather have some exposure, but the way we think about it is sort of looking top-down at the sectors. So through consumer discretionary, I think buys into a lot of those themes, so we'd keep that in place, and particularly since we're coming off a period of underperformance. But we also want to balance that with a couple of standalone themes, and I think that's why financials, it has some spillover, but I think that's more of a macro policy growth perspective, and any buy into any exposure to potential re-steepening of the yield curve. And top down, we balance those cyclical sectors with healthcare, which we see as just a little bit more defensive, and saying, okay, if we get a market that's not going back to heady returns, but beating bonds and cash, then that mix we think is a more appropriate mix of where we are today. So we have exposure to consumer, but we're not counting on that alone.
But so when you talk about financials, is it because of the RBI rate cuts that you alluded to earlier, right? Prime time for getting into NBFCs because they benefit in the short term? Or some skeptics would argue that, hey, it'll last for a couple of quarters, then it'll get clawed back and banks will stay in favor again, and therefore stick to banks because they are tried and tested.
So I think in this case, it would be a combination.
A mix of both.
Yes.
Come on, but that's the easy answer, Manpreet. So give us the difficult one.
No, the difficult one is that, look, yes, I think while you make a lot of valid points, I think it's not just about RBI rate cuts, but I think, if credit quality stays there and the yield curve's flattened a lot, if we get even some re-steepening, I think through the banks particularly is where you'll get some of that exposure. I think that's what we're really trying to get at. And I think what's interesting is that that's a slightly different story to the consumer growth ones. So we have more diversity in terms of sources of return.
I wonder how you look at IT, auto, some of the spaces from the Indian perspective, which will be more dependent on what's happening in the United States, the economy, trade deal, etc., rather than others. Would you say that this is a good time to stay away from them? Or on balance, India is going to come out ahead in all of these trade negotiations relative to other emerging markets?
So I think it depends where we ultimately end up on the tariff side, right? And all the reports in the media are positive. I think technology is perhaps the best example of where we were overweight very late last year. We cut it because that's perhaps one of the most impacted by tariffs and the uncertainty around it. And look, maybe it's something we reconsider if the tariff outcome, the eventual trade deal is, better than we expect, or at least, takes those challenges away, then perhaps something worth relooking at. But sitting here today, I think healthcare perhaps a better place to be. There is some exposure to tariff risk, but not quite as much. And I think more to offset it in terms of just market share on generics in the US or just the underlying, defensive characteristics. So at the moment, maybe dipping our toes in that risk via healthcare, but perhaps not going as far as tech.
So tech, you stay away. What about some domestics like defense, railways? Is that something that you look at all as India continues to push on capex?
So I think defense is a sector that's hard to ignore around the world, regardless of where we look. But yeah. I think we'd like to zoom out a little bit because there's also been a lot of interest and flows into it as well. I think the way we'd approach it a little bit different. I think, we look at it from a broader sector perspective, and I think where around the world we've taken more exposure is Europe in particular, because we think defense as part of the broader industrial sector, is slightly more attractive and perhaps less, overvalued or over-positioned exposure. I think in India, perhaps still focusing more on the consumer, financials, healthcare sort of stories.
Okay, consumer, financial, healthcare, and healthcare has turned out a few surprises off late, Manpreet. I mean, this whole fanfare around the CDMO space in India, and not just the external CDMO, right? Suddenly you see internal CDMO companies which are supplying to Indian companies for India use. That whole bucket of contracted outsourcing and manufacturing and research both, even CRO firms, is really come up. What do you think? I mean, this whole China Plus One thing, which has been supposed to be aiding since FY21, is it finally coming of age?
Well, to some degree, yes. And I think that's where we come from to say, look, if there is some challenges from the US tariff policy, yes. But I think all of what you described is what helps offset that to a large degree. It's the fact that you're getting much more positivity on the growth side, which is why we think markets will not worry quite as much about the tariff impact, particularly given not only the domestic story, but just the market share in the US as well. So a combination of factors.
Okay, just one, maybe I can just shift a little bit to the macro. Now, I heard you say initially in the conversation that you believe that this dollar strength and thereby flows into US, which was the case since 2022, might change. Do you guys anticipate this to happen in the second half of the year itself? Or could it be a slightly longer drawn thing? I'm just trying to understand when do you believe this trickle of inflows into EMs and Asia possibly could become a deluge?
So we do expect some of that to start in the second half itself. Indeed, I think we've already seen it happen. If you look at the performance of Asian equities, they've outperformed the US, in the first half already. And I think that's coincided with the 10% drawdown in the dollar index. Now, I think usually currency moves tend to be longer term in nature and not in a straight line. So in fact, over the next couple of months, I'd expect a bit of a counter trend rebound in the dollar. Everybody's too bearish the dollar already, and generally it goes in the opposite direction when that happens. But to me, that'll open up a great window to put on new sort of dollar week trades over the next couple of months. But I think we've been the strong dollar period. We've been in that since 2022. Right? If you look at if anyone follows the dollar index, we've been oscillating in this sort of 10% range, never really fell below that. We're now below that. We've had on the weaker starts of the dollar, through history. So we do think, this can be the start of a longer term trend.
Got it.
And which wouldn't be unusual by historical standards either.
All right. Thank you so much, Manpreet, for coming in and speaking to us.